Welcome back to another episode of FPO&G, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about everybody's favorite topic, government spending and future tax policy. Justin, we are recording this episode from our office in Fort Worth. For the three of you who watch on YouTube, you can see that we now have a bookshelf behind us, but it's very barren. So if you have any ideas for what to put up here, whether it be books, memorabilia, anything, we'd love to hear from you. Justin, I think it's important that we timestamp this episode. We are recording in early June of 2025. Is there anything going on that might, be connected to what we're talking about today?
Okay, let's see. So here we are, early June. I think it was within the last, 4 days or so that Donald Trump and Elon Musk had a little bit of a public breakup, right? And so, did Elon maybe leave officially his role within the government within the past couple of weeks? And so, efforts to reduce government spending, that's big news on the Doge front.
Yeah. So, I think that's a good place to start, right? Because they're kind of connected. And I would argue they're not perfectly connected. There's two components, right? There's future tax policy and then government spending. So I think it's a good time to talk about Doge. And of course, we'll talk about these things, but then we'll also talk about, okay, what does all of this mean to our primary audience of oil and gas professionals? So Justin, I'm curious, where do you want to take it with Doge? Just high level, do you think it was or wasn't a success? Why or why not? And do you think there was ever a reality where it would have been a success?
What's fun for our listeners, to give everyone a little bit of background, we actually wrote notes on doing this podcast, Jared, 5 months ago, beginning of the year, right? Somewhere around there. And then we had other episodes come up. And so it kind of got pushed to the back of the stack. And here we are actually recording it. And now it's a little bit in hindsight. And so in some ways, some of the original notes were maybe accurate, maybe not accurate. So it's kind of fun to look back and see some of those. I think the very first place to start is we want to really focus this on how does government spending affect your personal financial plan? And the most obvious way that anything in DC can affect your personal financial plan is future tax policy. And so I make that, disclosure, preface all of this just to communicate that, we don't want to have a political discussion here. We want to bring it all back to financial planning and making great financial decisions. I do think, Jared, vast majority of Americans can agree on some level, probably a varying level, that we pay a lot in taxes and government spending needs to come down, or maybe better put, government spending is just irresponsible. So I do think wherever you fall on the political spectrum, on some level, you probably agree with that statement. I think we need to root for government spending to come down. Some of my original notes was that I was really cynical that it would ever work, but again, I was massively rooting for it. I was massively rooting for Doge to be a success. Jared, I wanted to see them cut multiple trillions of dollars in the annual budget. And I wish that were possible. But again, in my original notes, I said that I was cynical that it would happen just because the government is an incredibly massive system and it's got a lot of momentum. It's got a lot of velocity going in the direction of excess deficit spending. And even if everyone goes into Washington, D.C. with the shared goal of bringing that down, that system is a force. And it's incredibly difficult to actually make material, meaningful, significant cuts to our annual budget. And so I would love to get into some of the specific numbers, but Jared, what else? What else do you think we should start with here?
No, I think just connected to Doge, I would say I thought it was going to be a failure from the get-go. I think power laws matter in everything. And if you think about the scope of where Doge was trying to cut, if you think about the high percentage of our spending that comes from Medicare, Social Security, Medicaid, defense spending, right? Those weren't, from my understanding, those weren't under the crosshairs of Doge, right? And if you spend, all of your time thinking about the slices of the pie that constitute, less than 20% of the spend, it's really hard to kind of move the needle when you've already started with, the accent pieces versus the main pieces. So I think it's a tough spot to be in. The spirit of it was very good, but again, getting back to what you're talking about, I think inertia is just such a powerful force. And
Well put.
and in politics, when relational capital is really paramount, there's a special incentive you have personal incentive plus momentum to not upset the apple cart, and spending, any form of government austerity creates frustration, right? Because there was going to be somebody who was getting money that's no longer getting money, right? So I think it's just very, very difficult to do.
Yep. Very well put. Jared, when we look at some of the actual numbers, if we think about the federal budget last year, so the spend rate is just under $7 trillion, right? And then revenue, we have just under $5 trillion. So we're spending $7 trillion. We're bringing in $5 trillion. We are spending $2 trillion more than we make every year. Now, it is interesting. One other data point that is important here: almost $1 trillion of our $5 trillion revenue goes to interest payments on our $36 trillion national debt. Now, Jared, these notes are a couple months old. I'm sure the debt is way beyond $36 trillion now. So maybe pushing 40, I'm not sure. Those are some interesting numbers. So if let's pretend that we want to have a balanced budget on an annual basis. The path to get there, it's not just take 7 down to 5. It's really take 6 down to 4. And that's pretty unbelievable. Your point about power numbers is certainly correct. At the end of the day, in order to cut 1/3 of a budget, you are removing entire departments, which I think financially would make a ton of sense. But the path to accomplish that is unbelievably difficult. Jared, I also just think, and something that we talked about from the get-go, this is a decade-long project. And, earlier this week, so Elon Musk and Trump kind of have a public separating of ways, a little bit of a public breakup, right? Well, it made me realize they only really got together. I think Elon formally endorsed Trump late last summer. So they were only together for like 9 or 10 months. And to accomplish even getting close to an annual balanced budget, I think that's a 10-year project. And we're talking about a system that has election cycles that are 2 years, 4 years, or 6 years. And so how do you even operate under that?
Yeah, that's like what we call in financial planning the mismatch of time horizon, right? If you need a decade plus to work it out, but everybody, comes to a set of agreement and they only have a 4-year period to enact it, that's tough, right? That's uphill swimming for sure.
I also think something that's been really a mark of every congressional spending bill, really, I would say for the past 10 or 20 years. So both sides of the aisle have done this. And this is, you see this in the most recent, the big, beautiful bill, the current congressional spending bill. Jared, the way they're structured is that you have a budget laid out, you have spending items laid out, and then the analysis that is supposed to tell the public what the effect of this spending bill will be on the deficit, both in the current and long term, it's all done in such a way where the deficit being lowered is something that is taking place like 8 years into the future, 9 years, 11 years into the future. And the calculations that determine that, one, they're a little fuzzy, but two, they're so many years out into the future that it's impossible for it to ever come to fruition. And everyone knows that this spending bill and the mechanisms that are actually supposed to maybe reduce the deficit in some small manner, well, they're going to be undone by either the next election cycle or the one after that. And so the math just doesn't even make sense.
And I would also argue a lot of it is predicated on a static party on the other end of the bill, right? Like I think all of this stuff is done in a vacuum, assuming that inflows will continue to mirror what they have been, right? But like there's cause and effect, right? When legislation changes one way, there's just so many unintended consequences. So it's just, I would argue it's impossible to come up with any clear assessment of, hey, this is exactly what's going to drive it, because your bill inevitably creates incentives, right? To do things differently, the same, So it's never going to be this simple thing. Hey, I raise it 10% and the income increases 10%, right? There's so much intricacy that's just not how it works in reality.
That's very well put. And yeah, I think, I do want to reiterate that I want the government to spend way less money. I think there are massive swaths of society today that are paying way too much in taxes. And we'll talk a little bit about that with Social Security and FICA. Tax rates do need to come down, but they can't. Our spending's completely out of control. Government spending is a runaway train that just has very little, the hope that this gets corrected, it's hard to see it happening anytime soon. And so, I root that it happens. My hopes are pretty low. My expectations are pretty low.
Yeah, it's like financial planning. It's like hope for the best, plan for the worst, right? And so thinking about who our audience is, I think there's probably unanimous agreement that, hey, Doge didn't do what we thought it was going to do. And this, which has illuminated this problem that cutting spending is way harder than people anticipated. What does that mean for our audience?
In many ways, Jared, I think it means nothing. In many ways, I think you just need to go build your life. You need to go build your balance sheet. Focus on your property. What's in your sphere, and don't worry about all of the other items and all of the things happening in DC. What do you think?
I think one of the things is, I think diversification is just always a valuable message, right? Like, we have no idea what this means for future tax policy, right? There's a deficit. Legislators will get creative in trying to manage that, right? And it's really difficult to turn the ship around at this point. But hey, what does this mean for tax policy in the years to come? I think the velocity of change is going to increase, right? Because I think the reality is everybody's increasingly agrees with this problem, but hasn't agreed on a solution or even have a matching time horizon to deal with the solution in a way that's necessary. So I think it's one of those things where, hey, deferring income indefinitely and just doing 1031 exchanges and hoping for a step up in basis might not be the best thing to do, right? And just, there might be a time and a place for realizing income, right? Knowing that the future is unknowable, thinking about, hey, what are lifetime tax rates? Where is there a lot of energy to increase or decrease taxation? Thinking about, your retirement plan and what that might mean for you. And I think, the future is unknowable. So I think if all your assets are one type or one registration, or your financial plan is contingent on one thing, like the step up in cost basis or whatever, right? Like, it might be time to diversify your strategy, because I think the velocity of change is going to pick up.
That's well put.
All right, Justin, let's talk about, right? I think the other like lower hanging, simpler example of like, okay, how does this impact our audience is like, okay, there's a spending problem, but also there's a solvency problem for something like Social Security, right? Which a lot of our listeners are either taking it or delaying it to take it, or, or so young that they don't even know if it's going to be there. So, how would you want to address the big hairy thing of Social Security in the context of this podcast?
Okay, Social Security is set to be insolvent within the next decade. The problem with Social Security is the problem with pensions in general. They don't really make a lot of sense with today's retirement age, one, but then two, longevity of humans. And so here's what I mean. Social Security was started, 1930s, right, Jared? So FDR era, and the general idea of Social Security was that we are going to have a system that can help those in society at the end of their life for a few years. And so in many ways it was, okay, Social Security income kicks in your 60s, and most people have passed away by 70, right? And so this is meant to be something that isn't lasting all that long. And then you fast forward to today, you think about the typical retiree. Obviously, you can look at actuarial tables and get kind of a lifetime estimate for how long someone might live, but then you really need to get more specific actuarial data. So not just what is life expectancy in America for a male and a female, but really you need to go, what is life expectancy for a male or a female who is relatively healthy at 58 years old? Those are two different questions. And two different answers. And so the problem is we are taking Social Security still in our 60s, but it's entirely possible that you live into your 80s, 90s, and beyond. And we're seeing millions of people do just that. And so that type of longevity and start date doesn't really make a lot of sense. That's why pensions are in trouble. That's why Social Security is in trouble. Where should we go from here, Jared?
No, I mean, I would just argue kind of like, hey, thinking actuarially about what is my future liability, it's an unknown for a few reasons, right? Like, hey, I don't know how long these people are going to live. It seems like it's increasing, but a lot of times when that math is done, it's assuming the technology that exists today, right? Like, like what is healthcare going to look like 10 to 15 years from now with everything going on in artificial intelligence, right? It's just, and that's the big problem. And that's why companies have moved away from it, because the problem with a defined benefit plan is I am on the hook for an unknown amount of money. Right? It's like there's no cap in terms of what my liability is. So it's really hard to plan for. And of course, with people living longer, that's great. But it also has created this weird system within Social Security where there's an asset liability mismatch.
That's right. That's absolutely right. Should we go into some of the ideas for changing it?
Yeah. What do you think?
Okay, first, we can link this in the show notes. I had a massive post on LinkedIn about this topic, but I think the really quick version of my idea is, Jared, we should just call a spade and take away the actual benefit for people our age and younger, and still have some form of taxation to fund Social Security for people that are, let's say, maybe it's over 40 or over 50. So continue to fulfill the promise that you've given people, but move away to a different system. And then, and we can just link that in the show notes. So dive into the details of how that could potentially look. So you can check that in our podcast webpage. But then I think another great idea, Bill Ackman shared this idea, and it would just be hilariously cheaper than our current system and would actually give people a significantly more valuable asset, most likely. And so we will link Bill Ackman's idea, but it's pretty simple. Bill just said the federal government should put $7,000 into an account for every citizen when they're born, and then have the same timeline that Social Security has. And guess what happens when you let $7,000 be invested in the public markets for 6 decades? It grows to an unbelievable degree. And so part of this idea from Bill is not just lowering the expense that the Social Security Administration takes on, but it's also giving just wildly more control, liquidity, access for Social Security recipients. And so in a model like this, maybe it's a thrift savings plan, Jared. Like maybe it's just $7,000 when a citizen is born into the thrift savings plan and it's invested. And then the thing about Social Security is you can't take it. You can't take a loan against it. If you pass away, your family doesn't really get it. And so it's not actually your asset. And so what if we change that? Wouldn't it be a better system if you did have more control, if you did have more liquidity, and you did have more access? And so I think that's part of the reason why it's also frustrating. It's incredibly expensive. Social Security is not remotely solvent. It's just about belly up, and the benefit's not even very good.
Yeah, I mean, and that's the thing is, it's kind of like doing what has already, been done in the marketplace, which is make it a defined contribution plan. Right. And essentially, hey, there's still a forced savings vehicle. Right. And I'm sure, you have to make it to where, I don't know what percent, we can talk about FICA here in a sec, but what percentage is responsibility of employee versus employer and mandatory, how mandatory is it and all of those things. But I think, that kind of creates some opportunity to do it. Because, I think, and again, this will get back to what the takeaway is, but I think it really depends on the listener, right? Because I feel like, anybody under 40 is, the financial plans we run, it's pretty discounted in terms of what we think the Social Security benefit is going to be, because it's such a large unknown and there's, not a lot of positive momentum. But Justin, we can't talk about Social Security without talking about your favorite phantom tax, FICA. So for our listeners who don't know, do you just want to explain what that is? Because I feel like it's honestly one of the like stealth tax or like most misunderstood taxes in the tax code.
Would love to dive into this. Okay, quick definition. FICA tax is something that all of you listening to this are familiar with, whether you know you're familiar with it or not. If you look at your pay stub, you obviously see income taxes. And if you're in a state income tax state, you might have withholding for your state income tax. But FICA is Social Security and Medicare tax that is taken out of payroll in your paycheck process. And so let's just focus on Social Security part of it. Medicare is 2.9% total, but then so 1.45% of Medicare tax, you pay it as the employee, and then your company as the employer pays another 1.45. Social Security structured in a similar manner, 6.2%, correct, Jared? Is the employee side, and then another 6.2% on the employer side. Now, there's a giant difference between Medicare tax and Social Security tax. The two of them combined are what make FICA. So whenever you hear the term FICA tax, that is Social Security and Medicare tax combined. But Social Security tax is different in the sense that Social Security tax has a wage base that you are taxed on. And when you make more than that number throughout the year, you actually stop paying Social Security tax. So right now, I believe it is around 176 to 180,000 is the current income limit that you're taxed on for FICA. So if you make $500,000 a year, well, you pay the Social Security tax, whatever the math is, like for Q1 for 3 or 4 months out of the year. And then once you have passed $175,000 or $80,000 in income, your Social Security tax stops and you pay no more. So now that we've defined it, Jared, there is one other idea to solve Social Security, make it solvent, and this idea would actually solve it very quickly. There would no longer be a deficit there. And I want to say this is Bernie Sanders' idea, but there's several different members of Congress or the Senate that have supported it. And the idea is take away the income ceiling that Social Security tax applies to. Go back to my last example. Let's say you make $500,000 a year. Currently, you only pay that Social Security tax on the first $176,000 or whatever it is in income each year. The idea is take that ceiling away. So instead, pay the Social Security tax on all $500,000 of your income. Or if you make $10 million, or if you make $200,000, whatever you make, have no limit on that Social Security tax. Jared, I think that is a truly horrible idea. I hate the idea. I am in awe at how punitive, how horrible FICA tax already is, how negative it already is, and the idea that we would actually tax more income at that stealth Social Security kind of manner just blows my mind. And I have absolutely zero faith that the additional revenue that the Social Security Administration would now get, I have no confidence that they would manage that well and that we wouldn't find ourselves in another pickle, 10, 20 years down the line. So I do think it is worth pointing out, Jared, how much has FICA kind of increased over the last 10, 20 years?
You know the data, but I think it's multiples of what it was even over the last 10 years. I know the hikes have been above and beyond what inflation and income has been.
Yes. And so if you go back, I want to say like 2014, 2015, I believe the income amount that was subject to Social Security tax was like $110,000 or $114,000. And today it's almost $180,000. And so we are seeing a massive, like almost a 50% increase in the amount of wages that are subject to the Social Security tax. And 6.2% when both the employee and the employer has to pay it, we're talking about tens of thousands of dollars. And this matters. Jared, I know we were kind of calculating just how much we pay, and we're an extremely small business. But if we didn't have to pay that 6.2% on every employee wage that we pay up below that limit, we would be able to pay our people more. And every business could say that. And so FICA is an incredible way that you are in kind of in a stealth manner. Like you said, you're paying a lot in taxes.
Yeah, I think if there was no FICA, we could match how oil and gas companies match.
That's right. Yeah.
But no, I think the other unintended consequence of this is it's punishing to small businesses or self-employed persons specifically, right? Like, I remember the first time as a self-employed person, I did my tax return and I was just blown away at how much in tax I owed.
Yeah.
Right. Despite it being one of my, when you start your business, it's pretty slim pickings, but any amount of income is kind of eaten up because, there are incentives for these, but it's not in the same way where, there's a standard deduction that just wipes out all your income. And as a self-employed person, you go from paying your employer portion of it to your employer or to your employee portion to employee and employer. So it really kind of creates this weird incentive in this, low income sole proprietor situation where their tax liability as a percentage could be kind of outrageous.
Absolutely. Absolutely. And I think that's a really powerful point. So match that with the idea to revamp Social Security. Man, Jared, how much more excited would you be to pay every employee of Brownlee Wealth Management, to pay that employer portion if it was going right into a thrift savings plan that they would have access to?
Yeah. Well, I'd be way more excited in that. So Justin, what would you say the takeaway for our audience is, right? Because we have people who are taking it, who are taking Social Security, who are thinking about taking Social Security, and then people that are decades away from taking it. So probably not thinking about it much, especially in light of its current condition.
Okay. Takeaway is you need to there's going to be two different takeaways depending on your age currently, but you need to understand how legislation has impacted Social Security over the last 10, 20, 30, 40 years. Okay, now first and foremost, Jared, if you are a young person, let's say you're in your 20s or 30s, you need to aggressively save and invest a lot of money. You need to use your greatest wealth building tool, which is your income, and you need to have a high savings rate. You need to find a way to put 15, 20% of your income into long-term investments. And you need to build your own financial stability, your own financial freedom, because you shouldn't count on Social Security being a massive safety net for you. Now, my advice for the crowd that's, let's say, over 50 is going to be totally different. And I think some of our listeners, after I just spent 10 minutes dogging on Social Security, I think some of our listeners might be surprised. You need to assume that it will be there. I cannot tell you how many people Jared and I talk to who are scared that Social Security is going to be ripped away at any second. So their takeaway is, I need to file to take Social Security at the earliest age possible. I need to take it at 62 because they're going to take it away from me. And I would say, don't have that mindset. We now have we have a track record from Congress that every time they make a change to Social Security, they typically do it in such a way where they are moving the FRA, full retirement age. And so full retirement age, at one point it was 65, then it was 66. It's in the process of being permanently moved to 67. And so there's some people where their full retirement age is 66 and 10 months because they're in that window where it hasn't quite fully moved to 67 yet. But if your full retirement age is 66 in a few months, or if it's 67, you need to most likely have that as the center point of at least wait until that point. And every Social Security decision is very custom. And so we're not going to even get into the idea of giving universal advice on when to take it. But you should not assume that you must take it at the earliest possible moment because it's going to go away. Every time Congress has moved full retirement age up, they've done it in such a way where if you are over 58 or 60 years old or 55, it doesn't affect you. The changes don't apply to you. Because obviously there's a pretty massive, really an ethical dilemma if the federal government were to change the rules on someone who is 61 years old, right as they get to the finish line. And so in the past, they've done tons of changes to Social Security, and they've always honored that idea. I think you should probably expect for that to continue. And don't shoot for the earliest possible filing strategy. Shoot for the optimal filing strategy.
Yeah, I mean, the only thing I would add is, right, like, I think preservation of benefits is one of the reasons Social Security is in the pickle that it is in, right? So, like, one of the reasons you're scared is because Social Security has paid honored benefits, maybe at the expense of longevity of the system. right? And so because of that, if you are close to the finish line, like you're saying, Justin, and finish line meaning when Social Security might enter the mix for you, I would kind of proceed as though it is, going to be available and kind of optimize around that, because legislatively, if you look at a lot of the past legislation, again, it's changing the trajectory versus the current reality of distribution, right? And again, getting back to inertia is such a powerful thing. I think it'd be pretty tough to sell changing reality for people today versus, passing a piece of legislation that impacts future beneficiaries. And so I think, if you're younger, I would kind of accumulate assets accordingly, right? And I would apply a pretty healthy discount rate to what you think Social Security is going to be. And again, I think it's one of those things where if I think about, one of the big benefits of Social Security, it's longevity risk, right? Like the math for delaying benefits gets better the longer you wait. And so, really, why do you have Social Security in the first place, or why are you delaying it? I think is something you should think through. But there's a lot of opportunities, and hypothetically, even if you delay to 70 or 72 by the time you retire, and you break even on Social Security benefits because your benefits gets reduced in the future, if that delay created 3 years of no income that created other planning opportunities, right? That could still be a meaningful difference, even if hypothetically you took less from Social Security. So there's a bunch of downstream consequences to where it could still be worth it, even though it feels scary. And there are kind of questions about longevity for decades to come.
That's well put.
All right, Justin, anything else before we kind of wrap up in terms of thinking about, tax and policy?
I think we've said this on the podcast before, but your expectation and your tax strategy moving forward, I think that you should assume that a lot of the future tax increases are going to be more stealth tax increases. And so FICA certainly falls under that. The removal of the stretch IRA. And so I think a lot of it is going to pertain to how can we raise Medicare premiums based on income rather than how can we just bluntly raise a tax rate. And so I think we're going to see a lot more stealth tax. And I think it's important to build some tax diversification in your balance sheet. And, Jared, I also think, I said at the beginning that the vast majority of folks would probably agree with me that taxes are too high and government spending is really wasteful. There are a lot of folks that will kind of push back on the first idea that taxes aren't actually that high, and they will point to historic highest marginal tax rates over the U.S. tax code. Let's say during the 1900s, we saw some tax rates that were double what the highest marginal rate is now. What was that, in the 50s, 60s? My rebuttal to that, though, is that that's totally meaningless if we have an 80% or a 90% highest marginal tax rate when legitimately no one actually paid that rate. And so that just means nothing. When today there really are a ton of people that are subject to the top rate. And so, at the end of the day, though, you really can't control where tax rates can go. All you can control is the things in your life that you can control. And so I do think that's a good question, the one you asked, Jared. Just what should the takeaway be? What should your application, if you're listening to this, be? And yes, pursue diversification in your portfolio, in your balance sheet, and in your tax registrations, certainly. But outside of that, just control what you can control. What other items do you think?
Yeah, I think just coordination matters, right? Like there's how does your income impact Social Security? How does your income impact Medicare, surtax? How does your income impact your capital gains rate? How does your income impact your ability to deduct or even make Roth contributions, right? Like all of those numbers that I just outlined are different numbers, right? So like the number of variables is not one coordinated system. There's, kind of getting back to what you're talking about stealth tax, the dimensions of the tax game are just, I feel like they're multiplying a little bit. So really have a concerted effort of, hey, what is my plan? And really, what am I solving for? Because you're not going to be able to optimize all of those tax dimensions across your whole life. So figure out what are your big rocks and really plan around those, because the rules of the game are changing and the number of variables that are increasing. So it's really difficult to build a plan that's perfect across all of those dimensions. So figure out, okay, what are you solving for? And in light of that, okay, what do I need to do today, tomorrow, and 10 years from now?
I love it. That's a great place to wrap it up.
Awesome. Well, I'm sure we answered every single question that anybody might have had about government spending in our future tax policy. No, I'm kidding. But I hope this was helpful for our listeners. We'd love to hear from you. What are you thinking about? What kind of keeps you up at night? How do you feel about these things? And are you changing anything in your financial plan? We love to hear from our listeners. Podcast at brownleewealthmanagement.com. Thanks. We'll see you next time.